We are going to keep you with hedge funds. We're going to bring in our guest, Nick DeMonico. He is the CEO of Hedge Fund Strategies Group at Common Fund. The firm has $25 billion under management. Its clients include nonprofit institutional investors, pension funds, family offices. Nick, always glad to see you here on Money Moves. Thanks for coming in.
Thanks, Georgia. Good to be here again.
I have to ask you, just because it's the day, what was the last thing you posted on Facebook?
I don't have a Facebook page, Georgia, and I'm sure if I had one, my boys wouldn't let me.
They wouldn't be letting you put pictures.
Now, so I don't.
But in all seriousness, you do actually have a small position in Facebook, which speaks to how hedge funds get involved in IPOs.
Actually, we have small positions in our hedge funds, and our venture funds have got positions as well, which is about all that my compliance people will let me say. But typically, the way that our hedge funds get involved in IPOs is sort of through the back door. Our distressed funds will take a piece of distressed debt, senior piece of debt, and typically you'll get an exchange, and there'll be a post-reorganization reorganization of the company. You'll get equity in exchange for that piece of debt, and then that equity gets sold into an IPO. So that's typically how we would get involved, and we have been involved in several of those transactions over the past few years.
Over the past few years. Well, I know you're working on, obviously, those things. You also are just back from Asia, and I wanted to ask you, what was it like on the ground there?
You know, the mood was, I would say, you hear cautious optimism a lot. It was pessimistic. I mean, I think most people were they were expecting this correction to come. A lot of the hedge fund managers that we spoke to last week had taken their net positions back to about 25 or 30%, which typically is on the low side for an Asian hedged equity manager. A lot of them felt that what they were seeing on the ground when they went out and interviewed companies in terms of revenues, in terms of earnings increases, was just not passing through, and did not augur well for an economy that's supposed to be growing at 7.5%.
So what are the managers most concerned about? Are they most concerned about the economy? Are they most concerned about politics? Is it a mix of the two or something else?
They're concerned about the growth they're seeing on the ground. That's one thing for sure. Some of the numbers that came out in China in April were not as strong as people thought. If you looked at retail sales and fixed asset investment and industrial production and things of that nature. But also they're concerned about what's going on in Europe. And a lot of the remarks were, things here would be might be all right if not for the European situation and if not for Greece, because it's all Greece all the time over there right now.
All Greece all the time, which brings us to a chart that I think we have, which just takes a look at correlations. Now, they have been dropping, and that's been great news. However, the past week and a half, we've seen a shift back to fear, it seems like.
We have, and that's okay. Volatility can go up as long as correlations stay low. That was the situation that we had in the markets between 2000 and 2002. Volatility spiked, correlations were low, and what we look at, this is a proprietary measure that was done by our quant team on the hedge fund team at Common Fund, and this measures broad market advanced decline, which basically is if you take the variance of returns from various S&P sectors and look at how much broad market moves or beta explain that variance. A high degree of broad market advanced decline is bad because you do not want market moves explaining most of the returns in stocks. You want fundamentals to explain those returns. That has dropped recently to about 50% from a high of 90% in the middle of last year.
So how are you setting up your strategy then based on what is going on in this environment?
We believe you should be really much closer to the center. I mean, our belief is that we're going through a series of mini cycles right now which have been driven by the central banks. We had one that was March of 2009 to the middle of 2010 when you had QE1 and TARP. Then you had QE2 from October of 2010 to the middle of last year. Then you had what amounted to QE3 with the LTRO coming out of the European Central Bank in December. That cycle has lasted till the end of March, maybe, and now it's all risk off again. So you need to stay balanced. We've moved our portfolios back to the middle. We like equity market neutral in this environment. We like hedged equity managers that carry lower nets. We do like long-short credit. We have clients that are looking for credit substitutes in this environment because yields are so low. And we do like CTA and macro managers because we think they still offer diversification and downside protection.
Okay, Nick. Thank you as always. Nick DeMonico joining us from Common Fund.